Recession fears are also growing in the United States. Here to sort out the signal from the noise is Jeff Small, president and founder of Arbor Financials. So Jeff, we just touched on this survey showing a marked decline in German economic optimism. But here in the United States, signals of a recession fears are also accruing. Yesterday, we cited a research note from Goldman Sachs that went over the weekend, warning of a 0.6% net hit to U.S. GDP growth and possibly a recession due to the trade war with China. Similarly, Morgan Stanley said that if the Trump administration follows through with all of its tariff threats, we will all see the global economy entering recession in 3 quarters. Now, this upcoming survey of asset managers by Bank of America shows a third of them believing a global recession is likely in the next 12 months, the highest figure of the point since 2011. So can all these players be wrong? It's not unimaginable. So give us your take here.
Wow, that's a lot of information to digest, but let me try and separate fact from fiction here and myth from reality. I think the global economy is going to go into recession regardless of what happens with the China trade deal in the United States. The global economy is already slowing down. There's $15 trillion of negative interest-rated debt out there. And that's not working very well for Europe and the rest of the EM markets. As far as the recession here goes, we know the economy is moderating. We don't see a recession right on the horizon. Maybe 12 months out or longer, we could see GDP growth hovering around 0. But as long as we have Republicans in control of the United States Congress and we have a Republican in the White House, I don't see GDP dipping below 0. I don't see a recession in the near future of 12 to 18 months.
Mm-hmm. And so, pivoting back to the U.S. economy, we saw inflation tick up a bit to 0.3% for July on cost increases in gasoline and rents. This is notable just after the Federal Reserve cut interest rates, citing little risk of inflation. Is there any risk that this could stall the uptick in inflation could scare away the Federal Reserve from any further interest rates cuts, which some are expecting?
There is absolutely a 0 chance of that happening, even though the Fed seems somewhat behind the curve here in controlling what's happening with rates. If there was a real threat of inflation, we would see the 10-year U.S. Treasury at around 265 to 250 instead of 165 where it is today. So the threat of inflation is really just an illusion. The Fed has been trying to find inflation or create inflation ever since the Great Recession of 2008 and 2009, and they couldn't create inflation if they wanted to.
So again, on interest rates, what are you telling your clients right now to prepare for that we seem to be in a race to lower interest rates worldwide?
Well, investors today really need a short game and a long game on their money. And the short game should be to create a defensive posture and de-risk their portfolio because we're really at the top end of the market cycle. Unless corporate earnings trajectories change and start to go up as opposed to go down like they have every month this year, and there's a positive China trade deal, the market's not really going to recover, and we're not going to see another 10 to 15% gain here, even though the market's up about 30% since 2017, hence another reason to de-risk. As far as the China trade deal goes, we don't see too much happening there. I guess the general consensus is they're probably going to wait it out. I don't see them giving President Trump a victory there. But if the Democrats get in, the Democrats are swearing they're going to be harder on the China trade deal. And so if I was the Chinese, I'd cut a deal real quick.
Mm-hmm. Now, stepping back, what is your overall take on this sort of economic moment and circumstance in the United States and your advice for different stakeholders? For example, you specialize in retirement. Well, what is your prognosis for others who may be seeking faster returns and may be comfortable with more risk in contrast?
Well, you know, this is a really big sticking point with me, and I'm really glad that you brought it up. All the talking heads today are still saying on TV that stocks are still more important than bonds, or they're valued more than bonds, and you should be more heavily weighted in stocks today. Nothing could be further from the truth. What you want to do is, if you're an investor of any age, is you want to take some risk off the table. There is no specific sector that you can dive into today that's going to prevent you and insulate your funds. When the market drops, the whole stock market drops. As long as it's a common stock, it's going to fall. There is not a particular sector that's going to pretty much create a mode of protection. So there's 2 ways to protect yourself. You can de-risk and go into cash, or you can go into fixed income and look at assets that produce dividends like bond and bond-like instruments and yields, things that generate income that are not market-centric.
That is, unless the U.S. goes negative interest as well. Jeff Small of Arbor Financials, thank you so much for being here.